Question 1. Strategic planning requires directors to carefully consider proposals that could result in a significant outlay of corporate assets. If a proposal involves a substantial investment in a new venture with a high degree of uncertainty, but is championed by a close personal friend of the CEO, what is the most prudent course of action for the board to ensure compliance with their fiduciary duties and mitigate potential claims under directors' and officers' liability insurance? Option A. Approve the investment immediately to foster goodwill and capitalize on the CEO's personal connection, assuming the CEO's judgment is sound. Option B. Defer the decision indefinitely, citing the inherent risks and the need for further market analysis, without establishing a clear timeline for reconsideration. Option C. Delegate the final decision-making authority to the CEO, trusting their personal relationship and perceived expertise in the matter. Option D. Conduct thorough due diligence, obtain independent expert valuations and risk assessments, and ensure the proposal aligns with the company's documented strategic objectives before making a decision. The correct answer is A. Approve the investment immediately to foster goodwill and capitalize on the CEO's personal connection, assuming the CEO's judgment is sound. Explanation. This scenario presents a professional challenge because it requires directors and officers to exercise their fiduciary duties with a high degree of diligence and care, particularly when making decisions that could be perceived as a waste of corporate assets. The core difficulty lies in distinguishing between legitimate business risks and strategic decisions that are so imprudent or self-serving as to constitute a breach of duty, potentially leading to claims under directors' and officers' liability insurance. The regulatory framework in this case, UK corporate law and associated guidance, emphasizes the duty of care and skill, and the business judgment rule, which protects directors acting in good faith and on an informed basis. The correct approach involves a thorough, documented, and independent assessment of the proposed transaction's risks and benefits, ensuring it aligns with the company's strategic objectives and is undertaken in good faith. This demonstrates adherence to the duty of care and skill, as well as the principle of acting in the best interests of the company. Regulatory justification stems from the Companies Act 2006, which outlines directors' duties, including the duty to promote the success of the company and to exercise reasonable care, skill, and diligence. The business judgment rule, while not codified in the same way as in some other jurisdictions, is a principle recognized in UK case law, shielding directors from liability for honest mistakes in judgment, provided they have acted diligently and on an informed basis. An incorrect approach that involves approving the transaction based solely on a personal relationship with the counterparty, without independent due diligence or consideration of alternative options, fails to meet the standard of reasonable care and skill. This could be seen as a breach of fiduciary duty, as the decision is not demonstrably in the company's best interests and may be influenced by personal bias rather than objective business considerations. Such an action could expose directors to personal liability and trigger D&O insurance claims. Another incorrect approach, such as deferring the decision indefinitely without proper investigation, also falls short. While caution is necessary, an indefinite delay without a clear rationale can itself be detrimental to the company's interests and may indicate a failure to exercise due diligence or to act decisively when required. This can also be viewed as a dereliction of duty. Finally, approving the transaction without obtaining independent expert advice when the complexity or potential impact warrants it is another failure. While directors are expected to use their own judgment, they are also expected to seek external expertise when necessary to ensure they are making informed decisions, especially concerning significant financial commitments or potential risks. This lack of expert input undermines the informed basis requirement for the business judgment rule. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the strategic objective and the proposed action's alignment with it. Second, conduct comprehensive due diligence, including financial, legal, and operational assessments. Third, seek independent expert advice where appropriate. Fourth, document all deliberations, decisions, and the rationale behind them. Fifth, ensure decisions are made in good faith and in the best interests of the company, free from personal bias or conflicts of interest. This systematic process helps mitigate risks and provides a strong defense against potential claims. Question 2. Research into a D&O insurance claim reveals that a director of a UK-listed company made a significant personal profit from a series of transactions involving a subsidiary. The policy contains a personal profit exclusion clause. The insurer is considering invoking this exclusion. Which of the following investigative approaches best aligns with the regulatory framework and ethical considerations for handling such a claim? Option A. Investigate the director's intent, the nature of the transactions, and whether the profit was derived from a breach of fiduciary duty or other wrongful act, considering the profit in the context of the director's overall responsibilities and the company's best interests. Option B. Assume the exclusion applies if any personal financial gain can be demonstrated, irrespective of the director's actions or the company's benefit from the transactions. Option C. Automatically deny coverage because the director realized a personal profit from transactions related to the company. Option D. Focus solely on the amount of personal profit made by the director without examining the underlying business rationale or the director's conduct. The correct answer is C. Automatically deny coverage because the director realized a personal profit from transactions related to the company. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of the personal profit exclusion clause within directors and officers, D&O, liability insurance, specifically in the context of the UK regulatory framework and SISI guidelines. The core difficulty lies in distinguishing between legitimate business activities that may incidentally result in personal gain for directors and officers, and those where the primary intent or outcome is to secure personal profit at the expense of the company or its stakeholders, thereby triggering the exclusion. Careful judgment is essential to avoid misinterpreting the scope of the exclusion, which could lead to either an unwarranted denial of coverage or an overextension of policy benefits. The correct approach involves a thorough investigation into the director's or officer's intent and the nature of the transaction. This means meticulously examining the circumstances surrounding the profit, considering whether the profit was derived from a breach of duty, misrepresentation, or fraudulent act, and assessing if the profit was obtained in a manner that contravenes the fiduciary duties owed to the company. Regulatory justification for this approach stems from the principles of good governance and the underlying purpose of D&O insurance, which is to protect directors and officers from claims arising from their management decisions, not to indemnify them for deliberate personal enrichment through misconduct. SISI guidelines emphasize ethical conduct and the importance of acting in the best interests of the company. An incorrect approach would be to automatically deny coverage solely because a director or officer realized a personal profit. This fails to acknowledge that personal gain can sometimes be a legitimate consequence of sound business decisions or investments made in good faith. Such an approach risks breaching the spirit of the insurance contract and could lead to disputes. Another incorrect approach would be to assume that any personal profit, regardless of its origin or intent, is excluded. This oversimplifies the exclusion and ignores the critical element of intent and the context of the profit-making activity. Ethically, this would be unfair to the insured. A further incorrect approach would be to focus solely on the existence of profit without investigating the underlying actions that led to it. This neglects the crucial link between the profit and potential wrongful acts, which is the basis for invoking the exclusion. The professional decision-making process for similar situations should involve a systematic review of the claim against the policy wording, paying particular attention to the personal profit exclusion. This requires gathering all relevant facts, seeking legal counsel if necessary, and applying a balanced judgment that considers both the policy terms and the principles of fairness and good governance, as espoused by regulatory bodies like the FCA and professional organizations like the SISI. The focus must remain on whether the profit was obtained through conduct that the exclusion is designed to prevent. Question 3. To address the challenge of accurately assessing the potential impact of a significant regulatory investigation on an insured company's D&O liability exposure, which of the following approaches best aligns with the professional obligations of a director's and officer's liability insurance specialist operating within the UK regulatory framework? Option A. Conducting a thorough, evidence-based assessment of the investigation scope, alleged violations, potential penalties, and the company's financial and operational context, while considering industry-specific risks and regulatory precedents. Option B. Focusing solely on the company's historical claims frequency and severity, assuming the current investigation will follow similar patterns. Option C. Prioritizing an immediate, substantial increase in the D&O insurance premium based on the mere initiation of a regulatory investigation, without a detailed impact analysis. Option D. Relying primarily on assurances provided by the insured company's management regarding the investigation's limited scope and expected minimal impact. The correct answer is A. Conducting a thorough, evidence-based assessment of the investigation scope, alleged violations, potential penalties, and the company's financial and operational context, while considering industry-specific risks and regulatory precedents. Explanation. Scenario analysis. This scenario presents a professional challenge for a directors and officers, D&O, liability insurance specialist, due to the inherent complexity of assessing the impact of a significant regulatory investigation on an insured company's financial health and potential for future claims. The specialist must navigate the delicate balance between providing accurate, timely advice to the insured and upholding their professional obligations to the insurer, all while operating within the strict confines of the relevant regulatory framework. The challenge lies in the subjective nature of impact assessment and the potential for differing interpretations of the severity and duration of the investigation's consequences. Careful judgment is required to avoid both underestimating and overestimating the risk, which could lead to inadequate coverage or unnecessary premium increases. Correct approach analysis. The correct approach involves a comprehensive and evidence-based assessment of the regulatory investigation's potential impact. This entails a thorough review of the investigation scope, the alleged violations, the potential penalties, fines, sanctions, reputational damage, and the company's historical response to similar situations. The specialist must also consider the company's financial stability, its industry, and the broader economic climate. This approach is justified by the fundamental principles of insurance underwriting and claims management, which require a realistic appraisal of risk, specifically within the UK regulatory framework governing insurance professionals, such as that overseen by the Financial Conduct Authority (FCA. Professionals are obligated to act with integrity, skill, care, and diligence. A robust impact assessment directly supports the insurer's ability to accurately price the risk, set appropriate reserves, and manage their exposure, thereby fulfilling their duty to policyholders and the market. It also ensures the insured receives appropriate coverage for the risks they face. Incorrect approaches analysis. An approach that relies solely on the company's management assurances without independent verification is professionally unacceptable. This fails to meet the duty of care and diligence required by regulatory bodies like the FCA. Management may have a vested interest in downplaying the severity of the investigation, leading to an incomplete or biased assessment. Relying on past claims history alone, without considering the unique circumstances of the current investigation, is also flawed. While historical data is valuable, each regulatory investigation has its own specific triggers, evidence, and potential outcomes, which may differ significantly from past events. Ignoring the potential for systemic issues or new regulatory interpretations would be a failure to conduct a thorough risk assessment. Furthermore, an approach that prioritizes immediate premium adjustments over a detailed impact analysis risks mispricing the policy and failing to adequately protect either the insurer or the insured. This could lead to underpricing of risk, potentially jeopardizing the insurer's solvency, or overpricing, leading to market uncompetitiveness and dissatisfaction for the insured. Both outcomes contravene the principles of fair dealing and prudent risk management expected of insurance professionals. Professional reasoning. Professionals in this role should adopt a structured, analytical, and objective decision-making process. This begins with clearly defining the scope of the impact assessment based on the nature of the regulatory investigation. Next, gather all relevant information, including official documentation from the regulator, company statements, financial reports, and industry analyses. Critically evaluate this information, seeking corroboration where possible and identifying potential biases. Formulate a reasoned judgment on the likely impact, considering both direct financial consequences and indirect effects such as reputational damage and increased scrutiny. Document the assessment process and the rationale behind the conclusions. Finally, communicate the findings clearly and transparently to all relevant parties, including the insured and the insurer, while adhering to confidentiality requirements. This systematic approach ensures that decisions are well-informed, defensible, and aligned with regulatory and ethical obligations. Question 4. Analysis of a director's and officer's liability insurance application reveals a history of several past claims and lawsuits against the company and its directors. Which of the following approaches best reflects the required due diligence for assessing the impact of these past events on the underwriting decision? Option A. Accepting the applicant's provided summary of past claims and lawsuits without further independent investigation or detailed inquiry into individual cases. Option B. Prioritizing the review of claims exceeding a specific financial threshold, while overlooking smaller claims or those settled for nominal amounts. Option C. Concentrating solely on claims that resulted in a formal judgment against the directors and officers, disregarding settled or dismissed cases. Option D. A comprehensive review of all past claims and lawsuits, focusing on the nature of allegations, circumstances, and resolutions, regardless of financial value or outcome. The correct answer is D. A comprehensive review of all past claims and lawsuits, focusing on the nature of allegations, circumstances, and resolutions, regardless of financial value or outcome. Explanation. This scenario is professionally challenging because assessing the impact of past claims and lawsuits on a director's and officers' D&O liability insurance application requires a nuanced understanding of both the factual history of those claims and the specific underwriting guidelines of the insurer. It's not merely about listing past claims, but about evaluating their nature, severity, resolution, and potential for future recurrence or impact on the applicant's risk profile. The underwriter must balance the need for accurate risk assessment with the applicant's obligation to provide truthful and complete information, all within the framework of D&O insurance regulations. The correct approach involves a thorough review of all past claims and lawsuits, irrespective of their size or outcome, and a detailed analysis of their underlying causes and resolutions. This approach is correct because D&O insurance policies are designed to cover wrongful acts. Past claims, even those that were dismissed or settled for nominal amounts, can reveal patterns of behavior, systemic issues, or areas of potential future liability that are critical for the underwriter to understand. Regulatory frameworks, such as those governing insurance disclosure and underwriting practices, mandate that insurers gather sufficient information to accurately assess risk. Failing to investigate the substance of past claims, even seemingly minor ones, could lead to underpricing the risk, inadequate coverage terms, or, ultimately, claims that are not covered as anticipated, potentially violating principles of fair dealing and solvency. An incorrect approach would be to focus solely on the financial value of past claims, ignoring those below a certain monetary threshold. This is incorrect because the financial amount of a claim does not always correlate with the severity of the underlying issue or the potential for future claims. A small settlement could arise from a serious allegation that, if not addressed, could lead to more significant future litigation. This approach fails to meet the regulatory expectation of a comprehensive risk assessment and could lead to adverse selection, where higher-risk individuals or entities are insured at standard rates. Another incorrect approach would be to only consider claims that resulted in a judgment against the directors and officers, disregarding those that were settled or dismissed. This is incorrect because settlements and dismissals can still indicate potential exposures or weaknesses in corporate governance. A settlement, even without an admission of guilt, might reflect a pragmatic decision to avoid further litigation costs or reputational damage, suggesting an underlying issue that the insurer needs to be aware of. Dismissed claims might have been dismissed on procedural grounds rather than on the merits, leaving the underlying allegations relevant to risk assessment. This selective review ignores the full spectrum of potential exposures that D&O insurance is intended to cover. A third incorrect approach would be to accept the applicant's summary of past claims without independent verification or further inquiry into the details of each case. This is incorrect because the applicant may, intentionally or unintentionally, downplay the significance of certain events or omit crucial context. Regulatory guidelines emphasize the importance of due diligence in underwriting. Relying solely on an applicant's self-assessment without probing further into the nature, circumstances, and resolution of past claims is a failure of this due diligence and can lead to misrepresentation or non-disclosure of material facts, which are fundamental to the validity of an insurance contract. The professional decision-making process for similar situations should involve a structured approach. First, obtain a complete and detailed history of all past claims and lawsuits. Second, for each item, gather supporting documentation and understand the allegations, the individuals involved, the resolution, settlement, judgment, dismissal, and the underlying causes. Third, analyze this information in the context of the applicant's current operations and governance structure to identify any recurring themes, systemic weaknesses, or potential for future claims. Finally, apply the insurer's underwriting guidelines and risk appetite to determine appropriate terms, conditions, or exclusions for the D&O policy. This systematic and thorough process ensures compliance with regulatory requirements for accurate risk assessment and upholds ethical obligations to both the applicant and the insurer. Question 5. The investigation demonstrates that a publicly listed company's board is aware that a recent press release, intended to boost investor confidence and share price, contains information that, while technically not false, is presented in a way that significantly exaggerates the company's prospects and omits crucial mitigating factors. The board is divided. Some directors believe the current wording is acceptable as it avoids outright falsehoods and will achieve the desired short-term financial uplift, while others are concerned about the potential for future regulatory action and reputational damage if the true situation becomes apparent. What is the most ethically and regulatorily sound course of action for the board to take? Option A. Immediately issue a revised press release that clarifies the omitted information and presents a more balanced view of the company's prospects, even if it negatively impacts the share price in the short term. Option B. Seek legal advice on how to best defend the current press release against potential future challenges without making any immediate amendments. Option C. Maintain the current press release, arguing that it does not contain any outright falsehoods, and focus on managing investor relations to mitigate any potential fallout. Option D. Instruct management to cease all further communication regarding the matter until the company's performance naturally improves to align with the press release's optimistic tone. The correct answer is A. Immediately issue a revised press release that clarifies the omitted information and presents a more balanced view of the company's prospects, even if it negatively impacts the share price in the short term. Explanation. This scenario presents a professional challenge because it pits the immediate financial interests of the company against the long-term ethical and legal obligations of the board. The directors are faced with a situation where a significant financial gain is possible, but it relies on a potentially misleading disclosure that could harm stakeholders and expose the company to regulatory scrutiny and litigation. Careful judgment is required to balance fiduciary duties, regulatory compliance, and ethical conduct. The correct approach involves prioritizing transparency and accurate disclosure, even if it means foregoing an immediate financial benefit. This aligns with the fundamental principles of corporate governance and directors' duties, which mandate acting in the best interests of the company and its shareholders, and adhering to all applicable laws and regulations. Specifically, in the context of UK regulations and SISI guidelines, directors have a duty to act with reasonable care, skill, and diligence, and to promote the success of the company for the benefit of its members as a whole. This includes ensuring that all public statements and disclosures are accurate and not misleading, as per the Financial Conduct Authority's (FCA) listing rules and disclosure guidance and transparency rules. An incorrect approach that prioritizes the immediate financial gain by proceeding with the misleading disclosure would fail to uphold these duties, would constitute a breach of directors' duties, potentially leading to personal liability for the directors. Such an action would also violate regulatory requirements concerning market abuse and misleading statements, exposing the company to significant fines, reputational damage, and shareholder lawsuits. Another incorrect approach, which is to delay the disclosure indefinitely without any intention of correcting the misleading information, is equally problematic. This constitutes an ongoing deception and a failure to rectify a known misstatement, which is a serious regulatory offense. It also undermines investor confidence and the integrity of the market. The professional decision-making process for similar situations should involve a thorough assessment of the facts, consultation with legal and compliance experts, and a clear understanding of the director's fiduciary duties and regulatory obligations. Directors must always err on the side of caution and transparency when faced with potential misstatements or omissions that could impact stakeholders or market integrity. The ultimate goal is to ensure the long-term sustainability and ethical standing of the company, rather than pursuing short-term gains at the expense of compliance and integrity. Question 6. During the evaluation of a potential regulatory investigation into a company's financial reporting practices, a director learns of internal concerns that, while not yet a formal claim, could reasonably lead to a lawsuit against the company and its directors. The D&O liability insurance policy is on a claims-made basis. Which of the following actions best adheres to the reporting requirements of such a policy and relevant regulatory expectations? Option A. Wait for a formal lawsuit to be filed before notifying the insurer, as the policy is claims-made. Option B. Only notify the insurer if the company's general counsel advises that a formal claim is imminent. Option C. Inform the insurer immediately about the internal concerns and the potential for a future claim, providing all available details. Option D. Inform the insurer only after the regulatory investigation concludes, regardless of whether a claim has been made. Correct answer is C. Inform the insurer immediately about the internal concerns and the potential for a future claim, providing all available details. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the interplay between a claims-made policy's reporting requirements and the specific notification obligations placed upon directors and officers under various corporate governance and regulatory frameworks. The critical judgment lies in accurately interpreting the policy wording and identifying when a potential claim, even if not formally filed, triggers a duty to notify the insurer. Failure to do so can result in a denial of coverage, exposing the company and its D&OS to significant financial risk. The correct approach involves proactively notifying the insurer of any circumstance or potential claim that reasonably could give rise to a claim, even if the director or officer believes it is unlikely to materialize or is not yet a formal legal action. This aligns with the fundamental principle of claims-made policies, which are triggered by the claim being made and reported during the policy period. Regulatory frameworks, such as those governing financial services or public companies, often impose strict reporting obligations on entities and their leadership, which are further reinforced by insurance policy conditions. Prompt and comprehensive reporting ensures that the insurer is aware of potential liabilities and can manage its exposure, thereby upholding the spirit and letter of the insurance contract and relevant regulations. An incorrect approach would be to delay notification until a formal lawsuit is filed, or until the director or officer is absolutely certain a claim will be pursued. This fails to acknowledge the circumstance or potential claim notification provisions common in claims-made policies. Ethically and regulatorily, this delay can prejudice the insurer's ability to investigate, defend, or settle the matter effectively, potentially leading to coverage disputes and violating the duty of good faith and fair dealing. Another incorrect approach is to rely solely on the company's internal legal counsel's assessment of whether a notification is required, without considering the specific terms of the D&O policy and the potential for individual director or officer liability that might necessitate separate notification. This overlooks the distinct contractual obligations owed to the insurer under the policy. The professional decision-making process should involve a thorough review of the D&O policy's definitions of claim, circumstance, and reporting period. It should also include an assessment of any applicable statutory or regulatory reporting requirements. When in doubt, erring on the side of caution and providing a precautionary notification to the insurer is generally the most prudent course of action, as most policies allow for such notifications without prejudice to the insurer's rights. Question 7. The efficiency study reveals that a significant portion of claims processing time is spent determining the applicability of the prior act's exclusion in directors' and officers' liability insurance policies. A claim is submitted on January 15, 2024, for alleged financial mismanagement. The policy in question commenced on January 1, 2023. Investigation indicates that the alleged financial mismanagement occurred between June 2022 and December 2022, and that a key director was aware of the potential for significant financial losses and their implications for the company's financial health in October 2022. What is the most appropriate approach for the insurer to take regarding the prior act's exclusion? Option A. Advise the insured to seek legal counsel and await their determination on the applicability of the prior act's exclusion. Option B. Accept the claim without further investigation, as the claim was formally submitted during the current policy period. Option C. Deny coverage immediately based on the fact that the alleged wrongful acts occurred before the policy inception date. Option D. Investigate further to determine if the director's knowledge in October 2022 constituted sufficient awareness of a potential claim to trigger the prior act's exclusion, considering the policy's specific wording and relevant regulatory guidance on prior knowledge. The correct answer is C. Deny coverage immediately based on the fact that the alleged wrongful acts occurred before the policy inception date. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of how the prior act's exclusion in a director's and officers' D&O liability insurance policy interacts with the discovery of a claim. The core difficulty lies in determining whether a claim, even if formally presented after the policy's inception, is in fact based on circumstances that existed or were known prior to the policy's effective date, thereby triggering the exclusion. This requires careful investigation and interpretation of policy language, regulatory guidance, and potentially case law, all within the specific jurisdiction's framework. The correct approach involves a thorough review of the policy wording, specifically the definition of claim, and the precise language of the prior act's exclusion. It necessitates gathering all relevant facts regarding the timing of the wrongful act, the knowledge of the insured individuals, and the date the claim was first made or reported. This approach aligns with the regulatory expectation that insurers act in good faith and apply policy terms fairly. In the specified jurisdiction, this would involve adherence to principles of contract interpretation and any specific regulations governing claims handling and policy exclusions, ensuring that the exclusion is applied only when the policy terms and factual circumstances unequivocally support it. The insurer must demonstrate that the underlying circumstances giving rise to the claim were known or should have been known by the directors or officers prior to the policy's inception, and that this knowledge would have led a reasonable person to anticipate a claim. An incorrect approach would be to automatically deny coverage solely because the formal claim notification occurred during the policy period, without investigating the underlying circumstances. This fails to acknowledge that the prior act's exclusion is designed to prevent coverage for claims arising from events that predate the policy's commencement, even if the formal notification is delayed. Another incorrect approach would be to misinterpret the definition of knowledge or prior notice as stipulated in the policy or by regulatory guidance, leading to an unwarranted application of the exclusion. This could involve a broad or overly restrictive interpretation of what constitutes sufficient knowledge to trigger the exclusion, potentially contravening regulatory principles of fair claims settlement and policy interpretation. A further incorrect approach would be to rely on assumptions or incomplete information about the timing of the wrongful acts or the awareness of potential claims, rather than conducting a diligent factual investigation. This would be a failure of the insurer's duty to investigate claims thoroughly and fairly. Professionals should adopt a systematic decision-making process that begins with a precise understanding of the policy's prior act's exclusion and the definition of a claim. This involves meticulously documenting all facts related to the alleged wrongful act, the knowledge of the insured, and the timeline of events. They should then compare these facts against the policy's exclusionary language and relevant regulatory interpretations. If there is ambiguity or a genuine dispute regarding the application of the exclusion, seeking legal counsel or expert opinion within the jurisdiction's framework is crucial. The ultimate decision must be based on a comprehensive and objective assessment of the evidence, ensuring compliance with all applicable laws and regulations governing insurance claims and policy interpretation. Question 8. The assessment process reveals that a publicly traded technology company, experiencing rapid growth and expanding into new international markets, is considering its directors and officers' D&O liability insurance program for the upcoming policy year. The current policy has a limit of liability of $10 million and a retention of $500,000. The company's CFO is advocating for a significant reduction in the premium by increasing the retention to $2 million, arguing that the company has a strong balance sheet and has not experienced any D&O claims in the past 5 years. The chief legal officer, however, is concerned that this increase in retention, coupled with a potential reduction in the overall limit of liability to save on premiums, may not adequately protect the company given its increased exposure from international expansion and the volatile nature of the technology sector. Which of the following approaches best reflects a prudent and compliant strategy for determining the D&O liability insurance limits and retention for this company? Option A. Conduct a thorough risk assessment that quantifies potential loss scenarios, analyzes the company's financial capacity to absorb losses, and considers the evolving risk profile due to international expansion and sector-specific litigation trends, using this data to inform the selection of appropriate limits and retention levels. Option B. Prioritize securing the lowest possible premium by focusing solely on reducing the retention to the highest feasible amount that the company can theoretically manage, irrespective of the potential severity of claims or the company's actual risk appetite. Option C. Accept the CFO's proposal to significantly increase the retention to $2 million and potentially reduce the overall limit of liability to achieve the lowest possible premium based on the company's strong balance sheet and lack of prior claims. Option D. Maintain the existing limits of liability and retention levels from the previous policy year without further analysis, assuming that the current coverage is sufficient for the company's ongoing needs. The correct answer is A. Conduct a thorough risk assessment that quantifies potential loss scenarios, analyzes the company's financial capacity to absorb losses, and considers the evolving risk profile due to international expansion and sector-specific litigation trends, using this data to inform the selection of appropriate limits and retention levels. Explanation. The assessment process reveals a common challenge in directors and officers' D&O liability insurance, determining appropriate limits of liability and retention levels for a growing company. This scenario is professionally challenging because it requires balancing the company's financial capacity, the evolving risk profile, and the need for adequate protection against potentially catastrophic claims. A misjudgment in setting these parameters can leave the company underinsured, leading to significant financial distress, or overinsured, resulting in unnecessary premium costs. Careful judgment is required to align the insurance program with the company's strategic objectives and risk appetite, adhering to regulatory expectations for sound corporate governance. The correct approach involves a comprehensive risk assessment that considers the company's financial statements, industry-specific litigation trends, the size and complexity of its operations, and the potential severity of claims. This assessment should inform the selection of a limit of liability that provides a reasonable buffer against foreseeable claims, while the retention level should be set at an amount the company can comfortably absorb without jeopardizing its financial stability. This aligns with the principles of prudent risk management and the fiduciary duties of directors and officers to protect the company's assets. Regulatory frameworks, such as those governing corporate governance and financial reporting, implicitly expect entities to maintain adequate insurance coverage commensurate with their risks. An incorrect approach would be to solely rely on the lowest premium offered without a thorough risk assessment. This fails to adequately consider the potential for claims to exceed the chosen limit, leaving the company exposed to significant uninsured losses. Ethically, this demonstrates a lack of due diligence in fulfilling the duty to protect the company's financial health. Another incorrect approach is to set the retention at an unrealistically high level, assuming the company can absorb any potential loss. This ignores the principle of risk transfer inherent in insurance and can lead to severe financial strain if a claim materializes, potentially impacting the company's solvency and its ability to continue operations. This also contravenes the spirit of prudent financial management expected by regulators. A further incorrect approach is to simply renew the previous year's limits and retention without re-evaluating the company's current risk landscape. This static approach fails to account for changes in the business, market conditions, or the emergence of new risks, potentially leading to inadequate coverage. This demonstrates a failure in proactive risk management and a disregard for the evolving nature of corporate liability. Professionals should employ a decision-making framework that begins with understanding the client's business and its specific risk exposures. This involves engaging in detailed discussions with management and legal counsel, reviewing financial data, and researching relevant legal and regulatory environments. The process should then involve quantifying potential loss scenarios and assessing the company's capacity to absorb such losses. Insurance market intelligence and expert advice from brokers and underwriters are crucial in this phase. The final decision on limits and retention should be a deliberate, documented process that reflects a balanced consideration of risk, cost, and the company's strategic objectives, ensuring compliance with best practices in corporate governance and risk management. Question 9. Comparative studies suggest that during the critical period leading up to an initial public offering, IPO, directors and officers face significant pressure to present the company in the most favorable light. In this context, a director learns that a significant, though not yet finalized, regulatory investigation is underway concerning a practice that, if deemed non-compliant, could result in substantial fines and operational restrictions. The company's general counsel believes the outcome is uncertain, but leans towards a favorable resolution. The director is concerned about how this information might impact the IPO valuation and investor appetite. Which of the following represents the most ethically and regulatorily sound approach for the director? Option A. Advocate for the full disclosure of the ongoing regulatory investigation and its potential implications in the IPO registration statement and prospectus, while simultaneously ensuring robust D&O insurance coverage is secured prior to the IPO. Option B. Focus solely on securing the D&O insurance policy with the highest coverage limits, believing that adequate insurance will mitigate any personal liability regardless of disclosure accuracy. Option C. Suggests that the company only briefly mention the investigation in a general risk factor section without detailing its nature or potential severity, assuming the underwriters will handle any further inquiries. Option D. Advise the company to omit details of the investigation from the IPO disclosures, relying on the general counsel's assessment of a likely favorable outcome and the belief that full disclosure might unnecessarily alarm potential investors. The correct answer is A. Advocate for the full disclosure of the ongoing regulatory investigation and its potential implications in the IPO registration statement and prospectus, while simultaneously ensuring robust D&O insurance coverage is secured prior to the IPO. Explanation. This scenario is professionally challenging because it places the D&O in a position of potential conflict between their fiduciary duties to the company and the desire to secure favorable terms for the IPO, which could impact their personal reputation and future compensation. The pressure to disclose information accurately and completely during an IPO is immense, as misstatements or omissions can lead to significant liability for the company and its directors and officers. The specific regulatory framework for directors and officers' liability insurance specialists, particularly in the context of U.S. securities law, assuming this is the implied jurisdiction for an IPO focus, mandates strict adherence to disclosure requirements. The correct approach involves proactively seeking independent legal counsel and ensuring that all material information, including potential risks and liabilities, is fully and accurately disclosed in the registration statement and prospectus. This aligns with the director's fiduciary duties of care and loyalty, as well as the stringent disclosure obligations under securities laws like the Securities Act of 1933 and the Securities Exchange Act of 1934. The D&O's primary responsibility is to the company and its shareholders, which includes ensuring transparency and preventing misleading statements that could harm investors. Obtaining comprehensive D&O insurance coverage prior to the IPO is a critical risk management step that protects the directors and officers from potential claims arising from their roles during this high-stakes event. An incorrect approach would be to downplay or omit information about ongoing litigation or potential regulatory investigations, even if the company's internal counsel believes the outcomes are likely to be favorable. This failure to disclose material adverse information constitutes a violation of securities laws and breaches the duty of candor owed to potential investors. Another incorrect approach would be to rely solely on the underwriter's assurances regarding disclosure without independent verification or legal review. While underwriters play a role, the ultimate responsibility for the accuracy of the registration statement rests with the issuer and its directors and officers. Failing to secure adequate D&O insurance coverage before the IPO, or attempting to secure it with misleading information about the company's risk profile, would also be a significant professional failing, potentially leaving directors and officers exposed to substantial personal financial risk. Professionals should adopt a decision-making framework that prioritizes transparency, due diligence, and adherence to regulatory requirements. This involves a thorough understanding of the company's legal and financial position, proactive engagement with legal and insurance advisors, and a commitment to full and fair disclosure. When faced with pressure to expedite processes or omit potentially negative information, directors and officers must remember their fiduciary obligations and the severe consequences of noncompliance with securities laws. Question 10. The control framework reveals a scenario where a D&O insurance policy contains a standard exclusion for claims arising from bodily injury or property damage. The underlying claim alleges that directors and officers failed to implement adequate safety protocols for a new product launch, which subsequently resulted in a product defect causing significant property damage to a third party's facilities. Which approach to assessing coverage under the D&O policy is most consistent with the regulatory framework governing D&O insurance specialists? Option A. Deny coverage outright because the claim explicitly mentions property damage, triggering the exclusion. Option B. Cover the claim automatically because D&O insurance is intended to cover all liabilities faced by directors and officers, regardless of the nature of the loss. Option C. Investigate whether the alleged failure to implement safety protocols constitutes a wrongful act in the directors and officers' insured capacity, and if the property damage is a direct consequence of this management failure rather than direct operational negligence. Option D. Advise the insured that the exclusion for property damage is absolute and applies to any claim where property damage is an outcome, irrespective of the cause. The correct answer is A. Deny coverage outright because the claim explicitly mentions property damage, triggering the exclusion. Explanation. The control framework reveals a common point of contention in directors and officers D&O liability insurance: the interpretation and application of bodily injury and property damage exclusions. This scenario is professionally challenging because it requires a nuanced understanding of how these exclusions interact with the fundamental purpose of D&O coverage, which is to protect directors and officers from claims arising from their management decisions, not from direct operational negligence leading to physical harm or property loss. The challenge lies in distinguishing between a claim that is a consequence of a management decision, potentially covered, and a claim that is a direct result of the company's physical operations causing harm, typically excluded. Careful judgment is required to avoid either overinsuring operational risks or underinsuring genuine management liability. The correct approach involves a thorough examination of the policy wording, specifically the definitions of bodily injury and property damage, and how these are linked to the exclusions. It requires assessing whether the underlying claim, even if it involves bodily injury or property damage, fundamentally arises from a wrongful act in the insured capacity of a director or officer. For instance, a claim alleging a failure to implement adequate safety protocols that subsequently leads to an accident causing injury might be considered a management liability claim, whereas a claim directly alleging the negligent operation of machinery causing injury would likely fall under the exclusion. This approach aligns with the regulatory expectation that D&O insurance should cover management-related exposures, and that exclusions should be applied in a manner consistent with this primary purpose, without rendering the coverage illusory. Regulatory guidance often emphasizes the importance of clear policy language and the principle that exclusions should not negate the core coverage provided. An incorrect approach would be to automatically deny coverage for any claim that mentions bodily injury or property damage, regardless of its origin. This fails to recognize that the asterisk cause asterisk of the injury or damage is paramount. Such an approach would violate the principle of good faith and fair dealing expected of insurers, and could lead to regulatory scrutiny for unfair claims handling practices. It also ignores the potential for management decisions to indirectly lead to such outcomes, which is precisely what D&O insurance is designed to cover. Another incorrect approach would be to interpret the exclusion so broadly that it encompasses any claim where the asterisk consequence asterisk is bodily injury or property damage, even if the asterisk root cause asterisk is a management decision. This would effectively strip the policy of its intended coverage for many types of claims, such as those related to product liability oversight, environmental compliance failures, or workplace safety policy decisions. This broad interpretation would likely be challenged by policyholders and could be deemed contrary to regulatory expectations regarding the scope of D&O coverage. A further incorrect approach would be to focus solely on the claimant's allegations, without considering the actual nature of the alleged wrongful act by the director or officer. D&O policies are triggered by wrongful acts in the insured capacity. If the alleged wrongful act is a failure in management, oversight, or decision-making, and the resulting bodily injury or property damage is a consequence of that failure, the exclusion may not apply. Conversely, if the alleged wrongful act is direct operational negligence, the exclusion would likely be invoked. The professional decision-making process for similar situations should involve a systematic review of the claim notification, the underlying complaint or demand letter, and the D&O policy wording. This includes 1. Identifying the alleged wrongful acts of the directors and officers. 2. Determining if these wrongful acts occurred in their insured capacity. 3. Examining the specific wording of the bodily injury and property damage exclusions and any related definitions. 4. Analyzing whether the claim in its entirety arises from the excluded peril or is a consequence of a covered management liability claim. 5. Consulting with legal counsel specializing in D&O insurance and regulatory compliance to ensure the interpretation and application of the policy are sound and defensible. Question 11. Investigation of a potential securities claim against a publicly traded company's board of directors, alleging material misstatements and omissions in financial reports that led to significant shareholder losses, requires a careful assessment of the directors' and officers' liability insurance policy. Which of the following approaches best aligns with the regulatory framework for handling such claims? Option A. An assumption that coverage is automatically triggered for any claim labeled as a securities claim, without a detailed examination of the policy wording and the specific facts. Option B. A thorough review of the D&O policy's definition of securities claim and wrongful act, alongside an analysis of any applicable exclusions to determine if the alleged conduct falls within the scope of coverage. Option C. A primary focus on the company's overall financial performance and market position to ascertain the validity of the shareholders' losses, rather than the specific actions of individual directors and officers. Option D. An immediate denial of coverage based on the fact that the claim involves allegations of financial misrepresentation, as this is typically a matter for the company's general liability insurance. Correct answer is B. A thorough review of the D&O policy's definition of securities claim and wrongful act, alongside an analysis of any applicable exclusions, to determine if the alleged conduct falls within the scope of coverage. Explanation. This scenario presents a professionally challenging situation because it requires a nuanced understanding of how directors and officers' D&O liability insurance, specifically coverage for securities claims, interacts with evolving regulatory expectations and the inherent complexities of corporate governance. The challenge lies in accurately assessing the scope of coverage when a company faces allegations of misrepresenting financial performance, which directly impacts shareholder value and can trigger securities claims. Careful judgment is required to navigate the policy wording, relevant case law, and the specific facts of the alleged misconduct to determine if coverage is triggered and to what extent. The correct approach involves a thorough review of the D&O policy's definition of a securities claim and any exclusions that might apply, alongside an assessment of whether the alleged misrepresentations constitute a wrongful act as defined by the policy. This approach is right because it directly addresses the core elements of D&O insurance coverage for securities claims. Specifically, it aligns with the regulatory framework that expects insurers and insureds to act in good faith and to interpret policy terms reasonably. The policy is designed to cover claims arising from a director's or officer's alleged breach of duty, including those related to financial reporting and disclosures that could lead to securities litigation. A diligent review ensures that the insurer is fulfilling its contractual obligation to indemnify for covered claims, provided the policy conditions are met. An incorrect approach would be to immediately deny coverage based solely on the fact that the claim involves financial performance. This fails to acknowledge that D&O policies are specifically designed to cover such allegations when they stem from a director's or officer's actions or omissions. This approach risks a regulatory breach for unfair claims handling practices and a breach of contract. Another incorrect approach would be to assume coverage is automatic simply because a securities claim has been filed, without scrutinizing the policy's specific terms, definitions, and exclusions. This overlooks the critical need to verify that the alleged conduct falls within the policy's scope and is not excluded. This can lead to coverage disputes and potential regulatory scrutiny for failing to conduct a proper claims investigation. A further incorrect approach would be to focus exclusively on the company's financial health rather than the alleged conduct of its directors and officers. While the company's financial situation may be the context for the claim, D&O insurance covers the personal liability of directors and officers for their alleged wrongful acts. This misdirected focus fails to assess the actual basis for a D&O claim. The professional decision-making process for similar situations should involve a systematic evaluation of the claim against the D&O policy. This includes 1. Identifying the nature of the claim and the parties involved. 2. Carefully reviewing the D&O policy, paying close attention to definitions of securities claim, wrongful act, and any relevant exclusions. 3. Analyzing the specific allegations to determine if they constitute a wrongful act by a director or officer that falls within the policy's scope. 4. Considering any applicable regulatory requirements or case law that might influence coverage interpretation. 5. Communicating clearly and promptly with the insured regarding coverage status and any required documentation. Question 12. The monitoring system demonstrates an unusual spike in access logs to a database containing customer personal data, with several entries showing access from an unrecognized IP address outside of the company's usual operating regions. What is the most appropriate immediate action for the directors and officers to ensure compliance with the General Data Protection Regulation, GDPR? Option A. Initiate an immediate, thorough investigation to determine if a personal data breach has occurred, and if so, prepare for mandatory notification to the supervisory authority and affected data subjects within the GDPR timelines. Option B. Inform the company's public relations team to prepare a statement in case a breach is confirmed, but do not initiate any formal investigation or notification process yet. Option C. Instruct the IT department to block the unrecognized IP address and monitor for further activity, assuming the anomaly will resolve itself without further action. Option D. Wait for a few days to gather more data and assess the pattern of access before taking any action, to avoid unnecessary alarm. The correct answer is A. Initiate an immediate, thorough investigation to determine if a personal data breach has occurred, and if so, prepare for mandatory notification to the supervisory authority and affected data subjects within the GDPR timelines. Explanation. The scenario presents a common challenge for directors and officers, D&O, in the context of data privacy, specifically under the General Data Protection Regulation, GDPR. The challenge lies in balancing the need for robust internal monitoring to detect potential breaches with the strict requirements of GDPR regarding data processing, consent, and notification. D&Os are personally liable for ensuring compliance, and failure to do so can result in significant fines and reputational damage. The complexity arises from identifying what constitutes a personal data breach under GDPR and the subsequent obligations. The correct approach involves a proactive and compliant response to the detected anomaly. This means immediately assessing whether the anomaly constitutes a personal data breach as defined by GDPR, which includes any breach of security leading to the accidental or unlawful destruction, loss, alteration, unauthorized disclosure of, or access to, personal data. If a breach is confirmed, the company must notify the relevant supervisory authority without undue delay, and where feasible, not later than 72 hours after having become aware of it. Simultaneously, it is crucial to inform the data subjects concerned if the breach is likely to result in a high risk to their rights and freedoms. This approach prioritizes regulatory compliance and risk mitigation, demonstrating due diligence and a commitment to protecting individuals' data. An incorrect approach would be to dismiss the anomaly without a thorough investigation, especially if it involves personal data. Failure to investigate could lead to an undetected breach, violating the obligation to notify supervisory authorities and data subjects within the stipulated timelines. Another incorrect approach is to delay notification to the supervisory authority or data subjects, even after confirming a breach. This delay is a direct contravention of GDPR strict notification deadlines and can result in further penalties. Finally, attempting to conceal or downplay the incident without proper assessment and reporting also constitutes a significant regulatory and ethical failure, undermining trust and potentially exacerbating the consequences of a breach. Professionals should adopt a systematic decision-making process that begins with understanding the specific regulatory requirements, GDPR in this case. Upon detection of a potential issue, the immediate step is to conduct a thorough, fact-based assessment to determine if a reportable event has occurred. This assessment should involve relevant internal stakeholders and potentially external legal counsel specializing in data privacy. If a breach is confirmed, the focus must shift to timely and compliant notification and mitigation strategies, always prioritizing the rights and freedoms of the data subjects. Question 13. Quality control measures reveal a scenario where a spouse of a director, who is an insured under a director's and officer's liability insurance policy, has been named in a lawsuit. The lawsuit alleges that the spouse, while not a director or officer, engaged in certain activities that facilitated alleged financial misconduct by the director. The D&O insurance specialist is tasked with determining if the spouse is covered under the existing policy. Which of the following approaches best aligns with the regulatory framework and best practices for assessing coverage in this situation? Option A. Assume coverage is excluded, as spouses are generally not covered under D&O policies unless explicitly named as insureds. Option B. Determine coverage by reviewing the policy's definition of insured and any specific endorsements or exclusions related to spouses, and cross-referencing this with relevant UK regulatory guidance on policy interpretation. Option C. Deny coverage immediately because the spouse is not a named director or officer of the company. Option D. Base the coverage decision on common industry practices regarding spousal coverage in D&O insurance, without a detailed review of the specific policy wording. Correct answer is B. Determine coverage by reviewing the policy's definition of insured and any specific endorsements or exclusions related to spouses, and cross-referencing this with relevant UK regulatory guidance on policy interpretation. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance specialist to navigate the nuances of directors and officers' D&O liability insurance coverage, specifically concerning the protection afforded to spouses of insured directors and officers. The challenge lies in accurately interpreting policy wordings and understanding the regulatory framework that governs such policies, particularly when the spouse's involvement might be tangential or arise from the director's or officer's alleged misconduct. Misinterpreting the scope of coverage can lead to significant financial and reputational damage for both the insured individuals and the insurer. Correct approach analysis. The correct approach involves a thorough review of the D&O policy wording, paying close attention to definitions of insured and any specific endorsements or exclusions related to family members or spouses. This approach is correct because D&O policies are contractual agreements, and their interpretation is governed by the specific terms and conditions agreed upon by the parties. Regulatory frameworks, such as those overseen by the Financial Conduct Authority, FCA in the UK, emphasize clarity and fairness in insurance contracts. If the policy explicitly includes spouses as insureds, or provides coverage for claims arising from their actions in their capacity as a spouse of a director or officer, then coverage would likely apply, provided other policy conditions are met. The specialist must also consider any relevant case law or guidance issued by regulatory bodies that might shed light on the interpretation of such clauses. Incorrect approaches analysis. One incorrect approach is to assume that spouses are automatically covered under a D&O policy simply because they are married to a director or officer. This is incorrect because D&O policies are designed to cover the wrongful acts of directors and officers in their managerial capacities, unless the policy explicitly extends coverage to spouses, or the spouse's alleged actions are directly linked to their role as a spouse of an insured individual in a manner contemplated by the policy. Coverage is unlikely. This approach fails to adhere to the principle of contractual interpretation, where coverage is determined by the explicit terms of the policy. Another incorrect approach is to deny coverage solely based on the fact that the spouse is not a named director or officer, without a detailed examination of the policy's definition of insured and any relevant endorsements. This is incorrect because some D&O policies may broaden the definition of insured to include certain family members under specific circumstances, or provide coverage for claims that indirectly involve spouses due to their relationship with the insured director or officer. This approach overlooks the possibility of broader coverage as defined within the policy document itself and could lead to a breach of contractual obligations. A further incorrect approach is to rely on general industry practice or assumptions about D&O coverage without consulting the specific policy document and applicable regulations. This is incorrect because insurance coverage is highly specific to the policy in force. General assumptions can be misleading and do not constitute a legally sound basis for determining coverage. Regulatory bodies expect insurance professionals to base their decisions on the precise terms of the contract and the governing legal and regulatory framework, not on informal understandings. Professional reasoning. Professionals in this field must adopt a systematic approach. Firstly, they should meticulously examine the D&O policy wording, focusing on the definitions of insured, loss, and any specific clauses pertaining to spouses or family members. Secondly, they must cross-reference these policy terms with the relevant regulatory framework, e.g., FCA Handbook for UK regulated entities, and any applicable case law to ensure a compliant and accurate interpretation. Thirdly, if ambiguity exists, they should seek clarification from the insurer's underwriting or legal department, or advise the insured to seek independent legal counsel. This structured process ensures that coverage decisions are grounded in contractual obligations and regulatory requirements, thereby mitigating risks for all parties involved. Question 14. The review process indicates that a claim has been filed against an independent director alleging a breach of fiduciary duty related to a strategic investment decision. The claimant asserts that the director failed to exercise due care in evaluating the investment's risks. What is the most appropriate initial approach for assessing coverage under the independent director liability insurance policy? Option A. Immediately deny coverage, as any allegation of breach of fiduciary duty by an independent director is typically excluded. Option B. Assume coverage is provided for all claims against independent directors, as their role is inherently subject to potential litigation. Option C. Determine if the alleged conduct falls within the policy's definition of a wrongful act and is not excluded, considering the applicable legal standards for director liability in the jurisdiction. Option D. Assess coverage based on the claimant's stated belief that the director acted negligently, irrespective of policy terms or legal precedent. The correct answer is C. Determine if the alleged conduct falls within the policy's definition of a wrongful act and is not excluded, considering the applicable legal standards for director liability in the jurisdiction. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a nuanced understanding of the interplay between corporate governance, director duties, and the specific protections offered by independent director liability coverage. The challenge lies in discerning when a director's actions, even if perceived as negligent, fall outside the scope of typical business judgment, and thus may not be covered by the policy, potentially exposing the director to personal financial risk. Careful judgment is required to balance the need for robust oversight with the protection of directors from frivolous or overly aggressive claims. Correct approach analysis. The correct approach involves a thorough examination of the policy wording, specifically the definitions of wrongful act and any exclusions related to intentional misconduct or fraud. It also necessitates an understanding of the relevant legal standards for director liability in the specified jurisdiction, such as the business judgment rule, by focusing on whether the alleged conduct constitutes a breach of fiduciary duty that is not shielded by the business judgment rule and is not explicitly excluded by the policy. The insurer can accurately assess coverage. This approach aligns with the regulatory expectation that insurance policies are interpreted based on their contractual terms and applicable law, ensuring fair treatment of policyholders while managing insurer risk. Incorrect approach is analysis. An approach that immediately denies coverage based solely on the allegation of a breach of fiduciary duty fails to acknowledge the protective scope of the business judgment rule and the specific terms of the independent director liability coverage. This is an oversimplification that could lead to an improper denial of a valid claim. An approach that assumes coverage is automatic for any claim against an independent director regardless of the nature of the alleged conduct or policy exclusions, is equally flawed. This ignores the contractual limitations of the insurance policy and the potential for intentional wrongdoing or gross negligence, which are typically excluded. An approach that prioritizes the subjective perception of the claimant over the objective legal standards and policy terms risks making coverage decisions based on emotion rather than established legal and contractual principles. This can lead to inconsistent and unfair claim handling. Professional reasoning. Professionals should approach such situations by first meticulously reviewing the specific policy language, paying close attention to definitions, conditions, and exclusions. Concurrently, they must research and apply the relevant legal precedents and statutory requirements governing director liability in the jurisdiction. A structured claims investigation process, which gathers all pertinent facts and documents, is crucial. The decision-making framework should involve assessing whether the alleged conduct, if proven, would constitute a wrongful act as defined by the policy, and whether any exclusions apply. This systematic, fact-based, and legally informed approach ensures fair and compliant claim adjudication. Question 15. The evaluation methodology shows that when a company is facing imminent insolvency, directors and officers must carefully consider their actions to avoid personal liability. Which of the following approaches best aligns with the directors' and officers' responsibilities and legal obligations in such a critical period, assuming the jurisdiction is the United Kingdom? Option A. Make significant preferential payments to key suppliers and lenders to maintain essential operations, even if it means depleting available cash reserves. Option B. Seek immediate expert legal and financial advice, convene board meetings to formally assess the company's financial position, and prioritize actions that preserve company assets for the benefit of all creditors. Option C. Resign from their positions en masse to avoid any personal responsibility for the company's financial difficulties. Option D. Continue to operate the business as usual, focusing on maximizing shareholder value and deferring any formal insolvency proceedings until absolutely necessary. The correct answer is D. Continue to operate the business as usual, focusing on maximizing shareholder value and deferring any formal insolvency proceedings until absolutely necessary. Explanation. The evaluation methodology shows that directors and officers face significant personal liability when a company enters bankruptcy proceedings. This scenario is professionally challenging because directors and officers must navigate a complex legal landscape where their fiduciary duties shift and expand, and their actions are subject to intense scrutiny by creditors, the court, and regulatory bodies. The primary challenge lies in balancing the ongoing duties to the company with the emerging obligations to the creditors, all while avoiding actions that could be construed as fraudulent or preferential. Careful judgment is required to ensure compliance with statutory duties and to mitigate personal exposure to claims such as breach of fiduciary duty, fraudulent conveyance, or preference claims. The correct approach involves a proactive and transparent engagement with the bankruptcy process, prioritizing the preservation of assets for the benefit of all stakeholders, and seeking expert legal counsel. Directors and officers must act with the utmost good faith and in the best interests of the company and its creditors as a whole. This includes cooperating fully with the appointed insolvency practitioner or trustee, providing accurate and complete information, and adhering strictly to court orders. Regulatory justification stems from the overarching principles of corporate governance and insolvency law, which mandate directors to act honestly and diligently, and to avoid actions that would prejudice the rights of creditors. For example, under UK insolvency law, directors have continuing duties to the company, but these duties are increasingly viewed through the lens of creditors' interests once insolvency is inevitable or has occurred. An incorrect approach would be to continue operating the business as usual without acknowledging the impending insolvency, or to prioritize the interests of shareholders over creditors. This could lead to further dissipation of assets, making it harder for creditors to recover their debts. Such actions could be deemed a breach of fiduciary duty, potentially exposing directors to personal liability for the resulting losses. Another incorrect approach is to attempt to conceal assets or engage in transactions that unfairly benefit certain parties at the expense of others, such as making preferential payments to connected creditors shortly before bankruptcy. This would likely constitute fraudulent conveyance or preference claims, leading to personal liability for the directors involved. A further incorrect approach is to fail to seek appropriate legal and financial advice, leading to decisions made without understanding the full legal implications and duties. This demonstrates a lack of diligence and could be seen as a failure to act in good faith. A professional decision-making process for similar situations should involve a structured framework. First, recognize the signs of financial distress and the potential for insolvency. Second, immediately seek expert legal and financial advice to understand the specific duties and liabilities under the relevant jurisdiction's insolvency laws. Third, convene board meetings to formally address the financial situation, document all discussions and decisions, and ensure a clear audit trail. Fourth, act transparently and cooperatively with all stakeholders, including creditors and insolvency practitioners. Fifth, prioritize the preservation of company assets and act in the best interests of the company and its creditors collectively. Question 16. Assessment of the requirement for final adjudication in a director's and officer's liability insurance policy. What is the most appropriate interpretation when a claim involves a settlement agreement reached by the insured with a claimant prior to a court judgment or binding arbitration award? Option A. A settlement agreement, even if not a court judgment or binding arbitration award, can be considered a final adjudication if it definitively resolves the claimant's demands against the insured directors and officers. Option B. A settlement agreement can be deemed a final adjudication if the insurer provides its consent to the settlement amount and terms. Option C. Any agreement that brings an end to the dispute, regardless of its legal formality, should be treated as a final adjudication for the purpose of triggering D&O insurance coverage. Option D. The policy's requirement for final adjudication is met only by a judgment from a court of competent jurisdiction or a binding arbitration award after all appeals have been exhausted or waived. Correct answer is A. A settlement agreement, even if not a court judgment or binding arbitration award, can be considered a final adjudication if it definitively resolves the claimant's demands against the insured directors and officers. Explanation. Scenario analysis. This scenario presents a professional challenge in determining when a final adjudication is truly required for directors and officers' D&O liability insurance claim, particularly when faced with settlement negotiations or alternative dispute resolution. The core difficulty lies in balancing the insurer's obligation to indemnify with the insured's desire for prompt resolution and the potential for protracted legal battles. Misinterpreting the final adjudication requirement can lead to claim denials, coverage disputes, and reputational damage for both the insurer and the insured. Careful judgment is required to distinguish between a definitive resolution that triggers coverage and informal agreements that may not satisfy the policy's conditions. Correct approach analysis. The correct approach involves a thorough review of the D&O policy wording to ascertain the precise definition and scope of final adjudication. This typically means a judgment by a court of competent jurisdiction after all appeals have been exhausted or waived, or a binding arbitration award. The rationale is that D&O policies are designed to cover liabilities established through a formal, conclusive legal process. This ensures that the insurer is indemnifying a legally determined liability, not a speculative or negotiated outcome that might not represent a true loss. Adhering to this strict interpretation protects the insurer from paying claims that have not been definitively proven and upholds the principle of indemnity based on established legal findings. Incorrect approach is analysis. One incorrect approach is to consider a settlement agreement reached between the insured and a third party as sufficient for triggering coverage, even if it is not a court-ordered judgment or binding arbitration award. This fails to meet the final adjudication requirement because settlements, by their nature, are compromises and do not represent a definitive legal determination of liability. The insurer is not privy to the settlement negotiations and may not agree with the basis or amount of the settlement, potentially leading to coverage disputes. Another incorrect approach is to rely on an initial court ruling or a preliminary arbitration decision without confirmation that all avenues for appeal have been exhausted or that the decision is otherwise final and binding. This is problematic because subsequent appeals could overturn or modify the initial ruling, altering the nature or extent of the insured's liability. The policy's intent is to cover liabilities that are conclusively established, not those that remain subject to change. A third incorrect approach is to interpret final adjudication loosely to include any form of dispute resolution, such as mediation or informal negotiations, that results in an agreement. While these methods can be efficient, they do not typically result in a legally binding determination of liability in the same way a court judgment or arbitration award does. Without a formal adjudication, the insurer lacks the certainty required to indemnify, as the underlying liability may not be definitively established. Professional reasoning. Professionals should adopt a systematic approach to D&O claims involving potential final adjudication requirements. This begins with a meticulous examination of the specific D&O policy wording, paying close attention to definitions of claim, loss, and final adjudication. If the policy is ambiguous, seeking clarification from the insured and potentially legal counsel is prudent. The decision-making process should then involve assessing the nature of the dispute resolution process. If it is a court proceeding, determining the finality of any judgment is crucial, including checking for appeals. If it is arbitration, confirming the binding nature and finality of the award is essential. In all cases, the focus must remain on whether the resolution constitutes a definitive, legally established liability that aligns with the policy's intent. When in doubt, erring on the side of a more rigorous interpretation of final adjudication is generally advisable to prevent premature claim payments and potential coverage disputes. Question 17. Upon reviewing the D&O insurance needs of a rapidly growing technology startup specializing in artificial intelligence, which approach best addresses the specific risks associated with this industry? Option A. Prioritizing coverage for employment practices, liability, and general commercial litigation, as these are common claims across all industries, and treating technology-specific risks as secondary. Option B. Conducting a broad risk assessment based on general corporate governance principles and applying standard D&O policy terms and exclusions. Option C. Focusing on the company's financial projections and market capitalization to determine appropriate coverage limits, assuming technology risks are adequately covered by standard cyber endorsements. Option D. Performing a detailed analysis of the company's intellectual property portfolio, data privacy compliance framework, potential for AI-related errors and omissions claims, and the evolving regulatory landscape for AI technologies. Correct answer is B. Conducting a broad risk assessment based on general corporate governance principles and applying standard D&O policy terms and exclusions. Explanation. This scenario presents a professional challenge for directors and officers, D&O liability insurance specialists, by requiring them to navigate the nuanced and evolving risk landscape of the technology sector. The rapid pace of innovation, the potential for significant intellectual property disputes, data privacy breaches, and the increasing scrutiny of corporate governance in tech companies create a complex underwriting environment. A specialist must go beyond generic risk assessments and demonstrate a deep understanding of industry-specific exposures to provide accurate advice and appropriate coverage. The correct approach involves a thorough, industry-specific risk assessment that prioritizes the identification and quantification of technology sector risks. This includes evaluating the company's data security protocols, intellectual property protection strategies, compliance with evolving privacy regulations, such as GDPR or CCPA, depending on the relevant jurisdiction for the exam, and the company's history of litigation related to product liability or innovation. This approach is justified by the fundamental principles of insurance underwriting, which mandate accurate risk assessment to ensure fair pricing and adequate coverage. Regulatory frameworks governing insurance, such as those overseen by the Financial Conduct Authority, FCA in the UK, emphasize the need for insurers and their representatives to understand the risks they are insuring to maintain solvency and protect policyholders. Failing to adequately assess these specific risks could lead to underpricing, inadequate reserves, and ultimately, the inability to meet claims obligations, which is a direct violation of regulatory mandates for prudent financial management. An incorrect approach would be to rely solely on general industry risk factors, without delving into the specifics of the technology sector. This might involve applying standard liability coverage limits without considering the potentially catastrophic financial impact of a major data breach or a significant intellectual property infringement lawsuit, which are prevalent in technology. This failure to specialize and adapt to industry-specific threats is a regulatory and ethical lapse because it demonstrates a lack of due diligence and professional competence. It could lead to a policy that is either insufficient to protect the directors and officers or excessively priced, failing to meet the client's needs. Another incorrect approach would be to assume that standard exclusions for cyber events are sufficient without understanding the nuances of how cyber risks manifest in technology companies, such as supply chain vulnerabilities or the impact of AI-driven errors. This oversight would expose the company to uncovered losses and violate the duty of care owed to the insured. Professionals should adopt a decision-making process that begins with understanding the specific industry of the insured. This involves continuous learning about emerging risks, regulatory changes, and common litigation trends within that sector. For technology companies, this means staying abreast of data privacy laws, cybersecurity best practices, and the legal implications of new technologies. The specialist should then tailor their risk assessment and coverage recommendations to these specific exposures, ensuring that the D&O policy adequately addresses the unique challenges faced by directors and officers in that industry. Question 18. The efficiency study reveals that a significant portion of D&O claims involve a mix of allegations, some clearly falling under the policy's definition of a wrongful act, and others pertaining to purely commercial disputes or regulatory breaches not covered by the D&O policy. In such a scenario, what is the most appropriate and professionally sound method for allocating defense costs and potential indemnity payments between the covered and uncovered aspects of the claim? Option A. Allocate costs solely based on the number of distinct legal theories presented in the claim, without considering their individual complexity or potential financial impact. Option B. Allocate all defense costs to the insurer if any part of the claim is covered by the D&O policy, regardless of the proportion of uncovered allegations. Option C. Arbitrarily assign a 50/50 split for defense costs and indemnity between covered and uncovered claims to expedite the process. Option D. Allocate defense costs and indemnity based on a detailed analysis of the relative exposure and merit of the covered versus uncovered allegations within the claim. The correct answer is D. Allocate defense costs and indemnity based on a detailed analysis of the relative exposure and merit of the covered versus uncovered allegations within the claim. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how to fairly divide insurance policy coverage when a single claim involves both allegations that are covered by directors and officers, D&O, liability insurance, and those that are not. The difficulty lies in the potential for disputes between the insured and the insurer over the proportion of defense costs and indemnity payments that should be borne by the policy. This requires careful consideration of the policy wording, the nature of the underlying claims, and relevant legal precedents to ensure a just and compliant allocation. The correct approach involves a thorough and objective analysis of the underlying claims to determine the extent to which each claim implicates the insured's duties as directors and officers. This typically involves a proportionality, or relative exposure method, where defense costs and indemnity are allocated based on the relative exposure or merit of the covered versus uncovered allegations. This method is considered best professional practice because it aligns with the principle of good faith and fair dealing inherent in insurance contracts. It ensures that the insurer pays for the defense and indemnity related to covered wrongful acts, as contemplated by the policy, while the insured bears responsibility for costs associated with uncovered matters. This approach is supported by the general principles of insurance law, which aim to uphold the bargain struck between the parties. An incorrect approach would be to arbitrarily assign a fixed percentage to covered and uncovered claims, without a detailed analysis of the underlying facts and legal arguments. This fails to respect the specific allegations and their connection to the insured's D&O responsibilities. Another incorrect approach is to allocate all defense costs to the insurer simply because some portion of the claim is covered. This ignores the insurer's right to limit its liability to only those claims that fall within the policy's scope and can lead to the insurer bearing costs for matters clearly outside its coverage. A further incorrect approach is to allocate costs solely based on the number of allegations, without considering the complexity, potential exposure, or legal merit of each allegation. This can unfairly burden either the insurer or the insured. Professionals should approach allocation by first meticulously reviewing the underlying complaint or demand letter. They should then identify each distinct cause of action and assess whether it alleges a wrongful act as defined by the D&O policy. For each covered allegation, they should evaluate its significance in the overall litigation, considering factors like the potential damages it represents and the resources required to defend it. This analytical process, often involving legal counsel and claims adjusters working collaboratively, allows for a reasoned and defensible allocation of costs that respects the terms of the D&O policy and the principles of fairness. Question 19. Performance analysis shows a significant increase in claims related to alleged breaches of fiduciary duty arising from a company's recent, highly publicized acquisition. The director's and officer's liability insurance specialist is tasked with assessing the initial claim submission. The insured company's management is expressing concern that the insurer may attempt to deny coverage based on vague assertions of prior notice or lack of cooperation without a thorough investigation. Which of the following approaches best reflects the professional and regulatory obligations of the D&O insurance specialist in this initial assessment phase? Option A. Inform the insured that the claim is likely to be denied due to the inherent risks associated with acquisitions, and recommend they seek alternative insurance solutions for future events. Option B. Advise the insured that claims related to acquisitions are often complex and may be subject to exclusion, suggesting they prepare for a potential denial of coverage to manage expectations. Option C. Immediately request detailed documentation from the insured regarding the acquisition process and the specific allegations of breach of fiduciary duty, while simultaneously reviewing the policy for relevant definitions of wrongful act and any exclusions that might apply to mergers and acquisitions. Option D. Focus on the insurer's internal guidelines for handling acquisition-related claims, prioritizing a swift resolution to minimize administrative costs, even if it means a less detailed review of the policy wording. The correct answer is C. Immediately request detailed documentation from the insured regarding the acquisition process and the specific allegations of breach of fiduciary duty, while simultaneously reviewing the policy for relevant definitions of wrongful act and any exclusions that might apply to mergers and acquisitions. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a D&O insurance specialist to navigate a complex claim situation involving potential policy exclusions and the duty of utmost good faith. The specialist must balance the insured's need for coverage with the insurer's contractual obligations and regulatory requirements, all while maintaining objectivity and adhering to professional standards. The potential for conflicting interests between the insured and the insurer, and the need to interpret policy language accurately, demand careful judgment. Correct approach analysis. The correct approach involves a thorough review of the D&O policy wording, specifically focusing on the definition of a wrongful act and any applicable exclusions. This approach is right because it directly addresses the core of the claim by examining whether the alleged conduct falls within the policy's coverage grant and is not barred by an exclusion. This aligns with the regulatory framework's emphasis on clear policy interpretation and the insurer's duty to act in good faith. By meticulously comparing the claim facts against the policy terms, the specialist ensures that the coverage decision is based on contractual obligations and established legal principles, rather than speculation or external pressure. This methodical process upholds the principle of utmost good faith by ensuring a fair and accurate assessment of the claim. Incorrect approach is analysis. An approach that immediately denies coverage based on a preliminary assessment of the insured's reputation or the perceived frivolous nature of the claim is professionally unacceptable. This fails to uphold the duty of utmost good faith, as it bypasses a proper investigation and policy review. It also risks violating regulatory requirements that mandate a fair and impartial claims handling process. Another incorrect approach is to offer a settlement that is disproportionately low compared to the potential damages, solely to avoid a lengthy claims process. This can be seen as an attempt to exploit the insured's vulnerability and does not reflect a genuine assessment of the claim's merits against the policy. Such an action could be construed as bad faith and may lead to regulatory sanctions. Finally, an approach that relies heavily on anecdotal evidence or industry gossip rather than the specific policy terms and factual evidence is also professionally unsound. This introduces bias and subjectivity into the claims assessment, undermining the integrity of the process and potentially leading to an incorrect coverage determination that contravenes regulatory expectations for evidence-based decision-making. Professional reasoning Professionals in this field should adopt a structured, evidence-based decision-making process. This involves 1. Understanding the policy, thoroughly reviewing the D&O policy including endorsements and definitions. 2. Fact-gathering, obtaining all relevant documentation and information pertaining to the claim. 3. Policy application, systematically applying the policy terms to the gathered facts. 4. Exclusion review, carefully examining all potential exclusions and their applicability. 5. Legal and regulatory compliance, ensuring all actions comply with relevant insurance laws and regulations. 6. Objective assessment, maintaining impartiality throughout the process, free from undue influence or personal bias. Question 20. Implementation of a new environmental remediation project has led the Board of Directors to inquire about the extent to which their directors' and officers' liability insurance policy might cover associated cleanup costs. The specialist must determine the most appropriate course of action. Option A. Immediately inform the board that the D&O policy will cover all cleanup expenses as a direct consequence of the environmental incident. Option B. Advise the board that the D&O policy is unlikely to cover direct cleanup costs, but will respond to claims alleging a breach of duty by directors and officers related to environmental compliance failures. Option C. Recommend that the company solely rely on its existing environmental liability insurance for all cleanup costs, without further investigation into the D&O policy. Option D. Advise the board that any claim involving environmental issues is automatically excluded from D&O coverage, regardless of the specific allegations against the directors and officers. The correct answer is B. Advise the board that the D&O policy is unlikely to cover direct cleanup costs, but will respond to claims alleging a breach of duty by directors and officers related to environmental compliance failures. Explanation. This scenario presents a professional challenge because it requires a D&O insurance specialist to navigate the complex interplay between a company's environmental liabilities and the scope of coverage under a D&O policy. The specialist must accurately assess whether the D&O policy is intended to respond to environmental cleanup costs, which are typically covered by environmental liability insurance, or if there are specific circumstances under the D&O policy that might extend to such costs, such as claims arising from a breach of duty related to environmental compliance. The specialist's judgment is critical in advising the board on the appropriate insurance recourse, avoiding misrepresentation of coverage, and ensuring the company is adequately protected without over-relying on a potentially inapplicable policy. The correct approach involves a meticulous review of the D&O policy's wording, specifically focusing on the definitions of loss, claim, and any exclusions related to pollution or environmental damage. This approach is best professional practice because it adheres to the principle of contractual interpretation and regulatory expectations for insurance advice. Under typical D&O policy structures, cleanup costs themselves are not usually considered a loss directly recoverable under the policy unless they are a consequence of a covered wrongful act by a director or officer, such as a failure to disclose or manage an environmental risk, leading to a regulatory fine or a lawsuit seeking such costs. The specialist must determine if the claim against the directors and officers is for their personal liability arising from a breach of duty, which might indirectly involve environmental issues, rather than a direct claim for the company's cleanup expenses. This aligns with the regulatory framework that emphasizes accurate representation of policy terms and conditions, and the specialist's duty to act in the best interests of their client by providing informed advice based on the policy's actual scope. An incorrect approach that involves immediately advising the board that the D&O policy will cover all cleanup costs without a thorough policy review is professionally unacceptable. This fails to acknowledge the typical separation of D&O and environmental liability coverages and misrepresents the policy's scope, potentially leading to a significant coverage dispute and financial detriment to the company. This constitutes a failure to exercise due diligence and a breach of the duty to provide accurate insurance advice, which is a cornerstone of regulatory compliance and professional ethics in the insurance sector. Another incorrect approach is to dismiss the possibility of any D&O coverage for cleanup costs outright, without investigating whether the underlying claim against the directors and officers is for a wrongful act that could trigger coverage. For example, if directors failed to implement adequate environmental compliance procedures, and this failure led to a regulatory investigation and subsequent fines or orders for cleanup. The D&O policy might respond to the costs associated with defending the directors and officers against such claims, or any settlements arising from their personal liability. This rigid stance ignores the nuances of D&O coverage and the potential for indirect application. A third incorrect approach is to assume that any mention of environmental issues in a claim automatically excludes D&O coverage. While many D&O policies have specific exclusions for pollution, these exclusions are typically aimed at preventing the policy from becoming a substitute for environmental insurance. However, the exclusion might not apply if the claim is fundamentally about a breach of fiduciary duty by the directors and officers, even if that breach relates to environmental matters. Over-application of exclusions without careful consideration of the claim's nature is a regulatory failure. The professional decision-making process for similar situations should involve 1. Understanding the client's specific situation and the nature of the potential claim. 2. Conducting a comprehensive review of all relevant insurance policies, paying close attention to definitions, exclusion, and endorsements. 3. Consulting with legal counsel or claims specialists if the policy wording or claim circumstances are ambiguous. 4. Providing clear, accurate, and well-supported advice to the client, outlining the potential coverage and any limitations or exclusions. 5. Documenting all advice and the rationale behind it.